FDs are safe, but their returns seem to be boring. Equities are exciting, but their returns are volatile. There is a mutual fund category called the Equity Savings Fund, which claims to be giving the best of both worlds: FD plus returns with lower volatility. Today, in this video, I'm going to test that claim with real data. And not just that, we're going to compare that with other equity categories in the same risk reward space. Also compare some of the top funds in this space on a historical basis. But before we taste the recipe, we would want to understand the ingredients of that recipe. So let's try and understand what equity savings fund is made of, what goes into making a product like that. If you notice, as per the SEBI circular, overall equity allocation should be minimum 65% of total assets, and minimum 10% of total assets should be in debt and debt related instruments. And they seem to be also enjoying equity taxation with that allocation. And why is that? Because the allocation seems to be more than 65% in equity and equity related instruments. These schemes enjoy a equity fund like taxation. Now, how come with more than 65% allocation in equity, these funds are still maintaining a lower volatility, right? So that's when hedged equities come into picture. Let me explain that with an example. Assume you bought 250 shares of Reliance in the spot market at 2,400 rupees, right? The value of your investment will go up when the value of these shares go up. But what if the value goes down, right? That's why a hedge position is created. So simultaneously, you also sell a Reliance futures contract. Let's assume the lot size is 250 shares at 2,415 rupees. So this way you are creating a hedge position by buying the shares in the spot market and also selling futures of the same equity. Now, you can see in different scenarios, you are still making a certain profit by maintaining this hedge position. And as a matter of fact, we all know that the prices in both spot market and the futures market would align on the day of expiry. So spot price on expiry, let's assume, has increased from 2,400 to 2,500. That means you gain 100 rupees on spot. You also lose 85 rupees because you are selling Reliance shares at 2,415, and the net P&L would be 15 rupees. Similarly, if the Reliance price falls to 2,300 rupees, you're losing on the spot market by 100 rupees, you're gaining on the futures market by 115 rupees, and your net P&L is still 15 rupees. And lastly, if your price remains same at 2,400, the profit on spot market will be 0, whereas the gain on futures will be 15 rupees. So as you've seen here, in different scenarios, right, even if the price goes up, goes down, or remains flat, you're still earning a certain profit by maintaining this hedged position. Now, I think we are all very clear how hedged and unhedged exposure help the fund maintain a lower volatility. But what exactly happens in reality is something that we can look at, right? I'll take an example of ICICI Equity Savings Fund. Here are the top holdings of ICICI Equity Savings Fund. You can see it has a savings fund of about 9% allocation. This mostly constitutes the popular bonds, government bonds, etc. Now, you can also see something interesting here. You see it holds about 7.5% of futures on HDFC, and at the same time it is holding in HDFC shares with almost the same allocation. So as you can see here, you are creating that hedged position by holding HDFC shares and also holding futures of the same company with a similar allocation, right? And you can see similar such hedged positions on Reliance. It holds a Reliance shares and also futures of Reliance. So this way, ICICI Equity Savings Fund is creating or leveraging on some of the arbitrage opportunities in the market. Okay, now that we have looked at the holdings of an equity savings fund as an example, how are they performing in reality? Is the claim that they have lower volatility really true? Now, you can see here the risk reward space. On the y-axis, you have the 3-year rolling return. On the x-axis, you have volatility. Now, you see a bunch of funds here. I took few categories as an example, mainly equity categories, which claim to have similar risk reward positions. So, for example, I've considered arbitrage funds, balanced hybrid funds, conservative hybrid funds, balanced advantage funds, multi-asset funds, and lastly, equity savings funds. Another thing to note here is the bubble size. The bubble size represents the max drawdown. So that means in its history, how much has it fallen from the peak to the bottom. So you see these small bubbles here. Maybe let me just zoom it. See, these small bubbles are essentially arbitrage funds. They have very less max drawdown. They operate within a 1 to 2% volatility band and start from nearly 4% to almost 7% rolling return. Now, if you move slightly towards the right, that's when you see a combination of conservative hybrid funds, equity savings fund, and maybe also a debt hybrid fund, right? So one thing that you should note here is till 6.5% you can rely on arbitrage funds, but the minute you want an extra return of more than 7.5%, 8%, you see that the volatility is almost jumping to more than 4%, right? So this is how these funds are operating. Now let's just look at only the equity savings funds. Now on my screen, you are just seeing the equity savings funds. In the previous screen, we've seen a bunch of categories. Now we're seeing just the equity savings funds. Again, the same y-axis and x-axis, and the bubble size representing the max drawdown. Now you see almost a range of volatility here, almost starting from 4 to 8%. The red bubbles are essentially funds with higher return in a similar volatility band. Now you see Edelweiss Equity Savings Fund seems to be having almost 9% 3-year rolling return within the 4 to 5% volatility band. Then you have UTI Equity Savings Fund, which seems to be giving you 11% 3-year rolling return in the 5 to 6% volatility band. And lastly, Mirai Asset Equity Savings Fund, which is in the volatility band 7 to 8% with 11.6% 3-year rolling return. Now, let's compare a couple of funds in this category historically how they have performed, right? So I'll just take the seemingly top two funds on this space, the Edelweiss Equity Savings Fund and the Mirae Asset Equity Savings Fund, and see how they have fared in the last few years. As you can see, I've selected Edelweiss Equity Savings Fund on my left, and on the right is Mirae Asset Equity Savings Fund. The blue line essentially represents Edelweiss and the red line represents Mirae Asset. If you can see, Edelweiss has been able to control the risk. You see a lesser drawdown during the COVID time. The blue line is mostly under the red line for almost all of its history. Now, if you look at the monthly returns, this is Edelweiss. During March 2020, you see a minus 5% drop for Edelweiss, whereas Mirae Asset has lost about 11% in the same month. Whereas when it bounced back, Edelweiss gave a 4.9% return, whereas Mirae Asset gave a 6.7% return, right? But I want to show you something interesting. If you look at the 1-year rolling volatility, you see Edelweiss has been mostly under the Mirae Asset Equity Savings Fund. And lastly, show you something interesting here. The 3-year rolling return for a long period, Mirae Asset seems to be on top of Edelweiss Equity Savings Fund. But as we get closer to 2026, you see these two curves are merging, right? So maybe some mean reversion happening here, but Edelweiss seems to be performing as well as Mirae Asset Fund. What you've seen earlier in the risk reward space is an average return of all of its history. But when you look at 3-year rolling returns on a timeline, that's when you see these nitty-gritties. You see that Edelweiss is actually performing as well as Mirae Asset Equity Savings Fund in the last few months. Now that we've looked at different funds, we looked at them in a risk reward space, we've compared two funds as well historically. So I want to give a final verdict on Equity Savings Fund. So this fund claims to have FD plus returns. Yes, it seems to have delivered those returns, but it also comes with commensurate volatility. Having said that, given that they enjoy equity-like taxation, and assuming you keep your assets in these kind of funds for a longer horizon, and you are in the 20 to 30% tax slab, the post-tax returns of an equity savings fund are going to be very interesting that you can hardly ignore. Thank you so much.